Hola a todos, me llamo María Gómez Silva y les saludo desde el estudio de la revista Inversión y Finanzas.com. Hoy vamos a hablar de renta fija y en concreto de high yield, de los bonos de alto rendimiento, que requieren una correcta asignación del riesgo, pero a cambio ofrecen más rentabilidad que los bonos de grado de inversión. Para hablar de ello tenemos hoy con nosotros a Uli Gerhard, que es gestor del BNY Mellon Global Short Dated High Yield Bond Fund. Uli nos saluda desde Londres. Hello Uli, thank you for joining me today.
Good morning. How are you?
Thank you. Fine, thank you. Let's talk about high yield. The first question is very simple. Why high yield now?
Well, I think high yield has become interesting because we suddenly have yield. Our asset class is called high yield, and if you go back 5, 6, 7 years, high yield asset class didn't have any coupons. Result of that, you weren't being paid for the credit risk, and more importantly, you weren't being paid for the volatility. Today, you can get in European high yield in between 6.5% coupons, and the US 7 to 8% coupons, which is attractive. And it really helps to have been in high yield for over 25 years, because these are the type of yields we saw if you go back to the early 2000s.
Anyway, investors are concerned about risk when it comes to high yield. What can you tell us about the default rates and the default outlook of this universe?
Okay, I think credit spreads, which are trading probably a bit more on the tight side, give you a very good indication what investors anticipate for credit losses and defaults. And we are anticipating probably about 2 to 2.5%. European high yield is running at the moment, year to date, under 1%. That's going to increase with the restructuring at Altice France, most likely. But what I would say is that if you do active fund management, and this I think is really, really important, high yield, active fund management, not too many names in your portfolio, you can navigate around the potential pitfalls.
Central banks play an important role in fixed income funds. What are your perspectives regarding monetary policy?
So we would anticipate that central banks at some point start to cut. The ECB probably starting first in June, and then we'll have to see how things are going to go. I think the biggest thing to consider for investments with 10-year bonds at 2.6%, where are they going to go? And I think that really gives you I think this is a really big question, because do you really want to buy long duration assets? Because quite frankly, we've been used to ultra low rates, which we don't think they're going to come back. And that means probably a 10-year bond at 2.5% is probably pretty fair. And you make money in long duration assets through falling long-term rates. This is not a given. So falling interest rates are not going to be your friend to make money. And if we then look at the United States, I think the United States, the economy is very different. It is running much better. The Fed might not cut this year. Who knows? I think one of the biggest issues we have, or problem for the ECB we have, is that if the Fed doesn't cut and the ECB does cut, with Europe being a strong importer, it will create import inflation.
Yes.
So the dog is going to bite its tail. That will tie the hands of the ECB how much they actually can cut.
So you don't expect many cuts in Europe?
I think we probably see 2 maybe this year, personally. That's my personal opinion. And we're going to see more next year. Where do I think, what is a sensible rate for European rates next year? Maybe 2.5%.
You have mentioned duration. What advantages may offer to take a short-dated approach in this universe of high yield? Can duration be handled in order to reduce risk?
I think the big advantage if you look at shorter duration in high yield, that means, the way we approach investing high yield, we want to be lending to a company for 2 years, and then after these 2 years, we can get repaid. And you probably agree with me that over those 2 years, my analyst team is able to model cash flows pretty accurately. And when a company generates cash flow, after investment, after paying their interest and all the bills, and there's money left over, which I can either use to pay higher prevailing interest rates or pay down debt, my probability to default is very, very low.
Mm-hmm.
And that's a big advantage if you play the front end of high yield. But more importantly, you need to run this as a very unconstrained approach. So you don't want to be indexed, because when you're indexed, you have to buy everything, and that means you'll buy default risk. You need to be very opportunistic, and this is why we set up this global short-dated high bond fund, which you can buy in the US, in developed markets, and European high yield. And this fund, I really want to emphasize, was set up for inside investments, pension funds, collateral, to manage the collateral money. And paramount for this was generate stable, predictable income, some capital gains. You mustn't lose any capital. And by the way, don't be too volatile.
Mm-hmm. Can you briefly describe how do you run your portfolio?
So I think we run our portfolios around 19 different companies.
Mm-hmm.
It is an analyst-driven approach. So the analyst decides what goes into the portfolio or out. We talk to our portfolio companies 6, 7, 8 times a year. So we'll know exactly if a company is on track or off track.
Mm-hmm.
If the company goes off track, the analyst makes a decision and the position gets sold if he doesn't like it anymore. It is very, very simple. And you might say, so where should that be? In what this should be a base allocation to everyone's portfolio. I'm very open to admit, I have money invested in this strategy, so investors can see actually,
your commitment.
I'm committed. I'm taking risk. I'm not taking risk I don't want to take myself.
Mm-hmm.
It is a low volatility product. And as you can see from performance, it didn't lose that much money in 2022. We lost about 5.3%. It more than caught up with that in 2023 with around almost 13% return. And even for 2024, we got slightly over 3% for the Euro share class investor in the bag. And we anticipate to end up the year in between around 7%.
Mm-hmm.
And I think probably also to make sure that we do not take any currency exposure risk. So that despite us being a global fund,
mm-hmm.
A Euro investor will be taking Euro currency risk.
Mm-hmm. And where do you find opportunities nowadays?
It is all over the place. You have to be very opportunistic. Our analyst team is set up in such a way that we can actually, we would like to lend in a specific sector. We're very opportunistic. We added to cyclicals in the third quarter last year when everyone didn't want to own cyclicals.
Mm-hmm.
We've been taking this down now. Again, we had 2 years ago no auto exposure. That had risen to about 12% today. That's down to about 5 to 6%. So we are very, very opportunistic. I don't want to say, we prefer dollars at the moment over euros. Why? Because I'd like to lock in these big coupons. Because a big coupon, what it means, when interest rates at some point going to fall, the call premiums are big. Because call premiums in high yield are 50% of the coupon. That means if I buy a bond with an 8% coupon, I'm going to make a current yield of 8% plus 4 points of capital gains. Pretty riskless.
You mentioned that you are an active manager. Is it crucial to be an active manager to run a fund in this space?
Well, I think, first of all, in high yield, it is vitally important to be active because companies change, management team changes, things happen. So you need to react to that. But more importantly, your analyst team needs to be active. And on top of that, you can't size positions. You have to size positions that you actually can exit. So if you own 50 million in a single name, difficult to get out. 15, 20 million, you can. And it also gives you then, we are very clear about this, that, the short-term bond fund strategy, the fund at the moment is around $930 million US.
Mm-hmm.
90 names, 20 million capacity per name. You're talking about 1.8 billion. So we don't really want to get bigger than 1.8 billion.
Mm-hmm.
That's very important to be able to act and to be flexible.
Mm-hmm. Well, it was a pleasure to have you here. Thank you for your time.
Thank you very much. Have a good day. Take care.
Y a ustedes, gracias por acompañarnos y hasta pronto.